All right, let's proceed with this 19 employee benefits. Then we are just trying to take a look at a special case, maybe when you have a curtailment. I hope you know the way of the meaning of curtailing, right? You know, by curtailing something, it's like just reducing it to a smaller level or actually totally removing it, right? That's what we mean by curtail. All right. We say that past service cost may be due to plan amendment, and they took a look at an example, but also it could be due to curtailment, just as we're going to see right now, right? Okay, so the question says, AB decides to close a business segment, right? That means the scale of operations is either removed in full or maybe partially, depending on the size of that segment. Okay, so the segment employees will be made redundant and will earn no further pension benefits after being made redundant. Do you see? I hope maybe I should tell you about one thing. We have something called amendment. You amend the plan of pension. We have something called curtailment. Curtailment, you remove, let's say you remove employees. All right. In that way, you compensate them, but also you remove the liability concern. But also, we have something called settlement. Settlement. Maybe an employee is moving from your own company to the other company, and maybe you transfer those obligations of those employees to the other company, but also you give a given consideration to that company. So you can have something called amendment, curtailment, or what? Amendment, curtailment, or what? What I just spoke of here. All right, you need to know about those three things or settlement. All right, this question is on curtailment, right? So if you are curtailing something, we say that something due to curtailment or amendment can be part of the past service cost. And it said that their planned assets will remain in the scheme so that the employees will be paid a pension when they reach retirement age. You know, it's not like an employee is just shifting to another. No, they're just being made redundant, right? So they have to stay. We are told that they have to stay until their retirement age matures. All right, i.e., this is a curtailment without settlement. Not exactly. This is what I wanted to see. That's very nice. Do you see here? We have the word curtailment, but also we have the word settlement. By settlement, someone moved from your company, and in turn, you have to extinguish their liability, but also you have to pay out something, right? So as to distinguish that liability, that's what you call it settlement. But as for curtailment, it's just something that's been reduced in operations, but actually you have not yet paid them, right? Okay, so we proceeded to say, before the curtailment itself, the scheme assets had a fair value of $500,000 and the defined benefit obligation had a present value of $600,000. Do you see this? So as usual, we usually have plan assets but also plan liabilities. So you have plan assets of 500K and then plan liabilities of 600K, giving you a net plan deficit, right? It's a net liability of 100, this minus this. All right. And then we're told that it is estimated that the curtailment will reduce the present value of the future obligation by 10%. Do you see now? But just by curtailing, you actually extinguish a part of the liability of the obligation, right? All right, so I told that it will reduce it by 10%, which reflects the fact that employees will not benefit from any future salary increases and therefore will be entitled to a smaller pension than previously estimated. I hope you understood this. You know, usually the obligation should be based on the salary for the last year, right? So since you are curtailing, it only goes to show that the obligation you initially anticipated is now going to change because actually the last salary which you considered so as to determine your obligations will now be reduced, right? Okay, so that's why you're told here that an obligation will follow in that manner, and we have been given the reason here, right? Okay, so what are we required to do? Required. What is net gain or loss on curtailment, and how will this be treated in the financial statements? Actually, about treatment in the financial statements, we said that whether it's on amendment due to amendment or curtailment, it affects past service costs, and so it would go to the statement of profit or loss. All right. So let's go and try to take a look at this, right? Okay. So you had the planned assets and planned liabilities, and now you are told that the obligation actually will actually have to decrease by 10%, right? The obligation was actually 600,000. So if you come here, you have to know what was there initially and then what has changed. So if you start with before here, we had the present value of obligation, which is a liability, is 600,000. Remember, I told that for something affecting liabilities, we usually use positive value, and for assets, we use negative value. But it's not necessary. This is just a decision because most assets, most of these plans have a net deficit. Right? That's why we decide to use the positive sign for liability, right? If you net them, you get the net obligation of 100, right? Yeah, that is the situation. Now, what happened on curtailment now? On curtailment, we are told that the present value of the obligation would be reduced by 10%. So it would be 10% times 600,000, which gives us 60,000, with no change in the fair value of the assets as they remain in the plan. The question itself stated that the obligation would reduce, but the assets would remain in the plan. In case it says that the assets would also be transferred, we would also have to transfer such assets, right? Okay, so on curtailment, we are told that the obligation would reduce by 60, so we reduce this by 60, right? But the assets stayed in the plan, so there is no change there. All right, now what would happen after what? After this curtailment? So I had 600 in present value of obligation, 60 reduced it, and so we remain with 540. And then as for plan asset, they remain as they were before, right? Doing this would give you the net plan deficit because 540 exceeds 500 by 40, right? So this should be the net obligation, right? All right, so you can ask yourself, right? Before you had an obligation of 100, and after you only have an obligation of 40. The obligation has decreased by 60. This means actually kind of an income, right? So it's a gain. So there has been a gain of 60. So this is what I will actually have to do right here. So as usual, the gain on sale and curtailment is 600,000, and this will be included as part of the service cost component in profit or loss for the year, right? Yes, as we said, service cost as actually current service cost and the past service cost, from which we can get information about curtailment or maybe plan amendment. So you have to include all of them, right? All right, right now I think we're just dealing with parts. Okay, let's see what. I think all right, we did all of this. I'm just trying to figure out. Rather, this is just an example. We did two examples of this, no issue. Okay, and then we have, maybe let's take a look at another question. For example, let's read this question. What is the requirement? The question says, explain the accounting treatment of the TC pension scheme for the year 31st March 2023 together with supporting calculation, right? So the year ends 31st March 2023, probably start at 1st April 20x2, right? Okay, let me tell you one thing. These questions are usually very straightforward. Just remember those line items. You start as net plan asset or liability. You have your interest component. You have the contribution. You have the benefits paid. You have the service cost. Just like that. Okay. The question says TC has a defined benefit pension plan and prepares financial statements for 31st March each year, right? The following information is relevant for the year ended 31st March 2023. This year starts 1st April 2022, right? Okay, the net pension obligation at 31st March 2023 at the end was 55 million. This is the net. If you see the word net, it means that the obligation has already net obligation. That means the obligation exceeded the asset. So it's already the difference. So it's 55 million. And at the first March 2022, which was the end of the previous year, is kind of the beginning of this year, right? The net obligation was 48 million. So we know the opening balance of the net obligation, and then we know the closing balance too. Now, as per our format, We usually start with the opening balance, right? Okay, and then we are told here that 48 million comprising the present value of the plan obligation stated at 100 million together with the plan asset stated at fair value of 52. All right, they're just trying to tell us how this 48 was arrived at, right? It was obligation of 100 minus assets of 52. The question proceeds and says the discount rate relevant to the net obligation was 6.25%, and the actual return on planned assets for the year was 4 million, right? This is the actual return on planned assets. You know, when you have the planned asset, they earn something, right? But also on the planned liability, you incur something. So the discount rate relevant to the obligation of 6.25 is given here. And the actual return on the planned asset for the year was 4 million, no issue. Other issues given here are current service costs, 12 million. You can also be given past service costs, but sometimes they will give you actually in words. You have to study to read the question carefully and know that by yourself. Okay, at the first March 2023, the end of the year, TC granted additional benefits to those currently receiving benefits that are due to vest over the next 4 years and which have a present value of 4 million at that date. Now, do you see this? So, actual additional benefits were granted to the to those currently receiving benefits that are due to vest over the next 4 years, right? And which have a present value of 4 million at that date. They were not allowed for in the original actuarial assumptions. So since they're not allowed for, you would have to include them, right? No issue. This question now is not straightforward. You have to go move at one line item to another and then to solve this. I'll actually give you one question. During the year, TC made pension contributions of $8 million into the scheme, and the scheme paid pension benefits in the year amounting to $3 million. You know, as I told you, there are matters which are very obvious. All you need to know right now is there are issues that will increase plan assets, there are issues that will increase plan liabilities, there are issues that will increase both plan assets and plan liabilities, and there are issues that will decrease both. That's something you really need to know, right? Even if you forget, just try to know, oh, we have this kind of things. And then if you memorize, you'll get that. If you do remember, we spoke about contribution, about these benefits, about the service cost, right? Okay, so this is what you're required to do. Just to explain the accounting treatment, okay? Then now let's go to test understanding number 4. So number 4, let's just remember the plan obligation at the end was 55 and at the beginning it was 48. And we are given the assets here 100, liabilities 100 and assets 52, right? Okay, let's go to number 4, test understanding number 4. Here it is. Okay, now as usual, I usually tell you that you start with the opening balance, net obligation brought forward, liabilities have exceeded assets. I just don't know. I just don't know what happened here. Isn't this oh care brought forward? Didn't they change? Maybe okay, all right. What was the opening balance? You know, we had 48 and 55, right? 48 was the opening balance and 55 the closing. Is it? Let's check. Let's check. I don't remember that well. Let's go and see if that is the case. Number 4, yes. Oh yes. This one was at the end. At the first mathematics it was 55 and at the beginning it was 48. All right, that's fine. I thought they are done in the reverse way. Okay. So let's proceed here. It's number 4. We have the net obligation at the beginning brought forward of 48. This was given. And as I told you, you add the net interest component. Right. You are given, you use that discount rate. You are given the discount rate of 6.25, right? So 6.25 times 48, 6.5% actually times 48, and you obtain 3 here, right? Okay. Then how do we proceed after that? You have the service cost component. And as for service cost component, you can have the current service cost, but also the past service cost. Now, The question gave us implicitly the current service cost, and the current service cost was 12, right? Now I need you to, actually there's something I needed you to be careful on. It is this past service cost. Now take a look at here. They just wrote here that past service cost equals to 4. Now you have to go back there and see how they arrived at that past service cost of 4 million, right? Past service cost of 4 million. Maybe we should go there directly on the question. It's number, what, number 4? Yes, here. All right. At the beginning, actually, I think you've already used these figures here. The discount rate, you already used it. Current service cost. Yes, this line here. At the 1st March 2023, TC granted additional benefits to those currently receiving benefits that are due to vest over the next 4 years and which have a present value of 4 million at that date. Do you see this? They are not allowed for in the original actuarial assumptions. These were not allowed for in the original actuarial assumption. That means there is some relation to the past, right? And so that's why we say that they have to give the employees this 4 million, but this relates to the past, so we call it past service cost. Sometimes past service costs are not given directly, so you really have to understand this. All right, for contributions and the benefits paid, I think they are given obviously. It's 8 and the 3, although benefits won't have an impact. Okay, so if you come here and proceed, you have the past service cost like that. So you have current service cost and the past service cost. All right, in case this question was having maybe gain on settlement, gain on or loss on curtailment, would have included them here. Just remember that if it's a gain, it is going to reduce this past service cost, right? This service cost component. If it's a loss, it will have to increase. Okay, so you can just proceed. They just decided to add them together to obtain 16. So 16 is the total service cost. Okay, the question gives us contributions into the plan. I told you that contributions increase assets because if you contribute, some more assets can be bought, or maybe you have just contributed cash, that's also an asset. So contributions increase assets and so they decrease liability. I told you that whatever increases assets, put it as negative, whatever increases liability, put it as positive. We also have benefits paid, but benefits paid, as I told you before, they have a nil. You have to include the you do not have to include anything because these reduce both assets but also reduce liability. You pay the benefits out of the assets to settle liabilities. So the same amount you remove from assets is the same amount you go and settle liabilities. That's why since this one is usually presented as the net value, it will have no impact, right? Okay. And then after this, you will have to obtain the carrying amount. 3 plus 16 equals to 19. 19 minus 8 equals to 11, right? 11 plus 48 equals to 59. So, all right, maybe let's do this. 48 plus 3, 51, plus 16, 67, minus 8, it is 59. So, the carrying amount is equals to 59. I think in an exam, you could have just written 59 here first. This remeasurement component is usually obtained after comparing that carrying amount of 59 with this net obligation at the end. So net obligation carried forward was 55. So you find out that, oh, so I had a 59 carrying amount, but actually, after converting the actuary has told you that, oh, there really is a net obligation of 55. So 59, reducing an obligation from 59 to 55, you have to reduce an obligation by 4. So if you reduce an obligation, it's kind of a gain, right? That's why I told you, if it's a gain, put it as a negative sign because a gain increases assets, right? So if it's a gain, you actually have to take it as a negative sign. It's just a grade here. Although you can do it any way you wish. The remeasurement component here, so call it remeasurement component. Here you could have written remeasurement gain or actuarial gain. And this usually goes to the other comprehensive income. So net interest component goes to profit or loss, service cost to profit or loss, contribution to the plan, this goes to statement of cash flows as cash, benefits paid won't have an impact here, and then remeasurement component goes to the other comprehensive income. And this figure here at the end would be your carrying balance in the statement of financial position, right? Yeah, so that's something you really need to obtain and understand here, okay? All right, I think you have seen about this already, so it's not much of a big deal. let's just go back to let's just proceed with the explanation so that we finish this. Okay, as I just told you that the discount rate is applied to the net obligation brought forward as usual, and you get that net interest component. The current service cost together with the past service cost, these are usually combined to obtain the service cost component. All right, what is the past service cost now? It is charged in full usually when the scheme is amended. This is obvious because if you amend the scheme and it's a past service cost, that means you have to realize it directly. That's why you realize it in full. That's why they write here in full, right? Rather than when the additional benefits vest. We do not care about when the benefits vest. The total service cost actually is 16 million as we just did that, and this is charged to profit or loss. Let me tell you one thing. If in an exam you are told to explain the accounting treatment is not computation. You have to do computation so as to be able to explain. But the accounting treatment, you have to explain this, where does this go? This is the amount. This amount goes there. Right. Just as I told you here, just after explaining this, I told that this goes to profit or loss, this goes to other comprehensive income. You have to specify that, right? Okay, then if we proceed and we say that to the extent that there has been a return on assets in excess of the amount identified by the application, let me just tell you one thing. If you do remember, we are told that there was kind of a return from the question. So we are told that, if you have the planned assets and you invest, you expect to earn something, right? So what do? To the extent that there has been a return on assets in excess of the amount identified by the application of the discount rate, to the fair value of the planned assets. This is part of the remeasurement component. Do you see this now? Now let's go and take a look and see actually how we can go about this, right? Yes. At the end of the year, we had planned liabilities of 100 and then we had planned assets of 52, right? Now, if we had planned assets of 52, now ask yourself, when we took that, let me go up here. This question is very good actually. Do you see this net interest component? It is 6.25% times 48. 48 is the difference between liabilities of 100 and assets of 52 from that question. So you just try to determine the interest based on the planned assets alone. So 6.25% times 52, 6.25% times 52, I hope this should be the value. This one is 3.25. If you take 52 million times 6.25, you get 3.25. Now, after getting that, you say, oh, this is the interest I expected to earn from the planned assets. But what did I actually earn? What was actually earned? Let's just go to the question and take a look. What did we really earn? Actually, from the question, you find out that how much, I just don't see that. I don't see that. Yes, here, this one. We are told that the actual return on planned asset for the year was 4 million. Now, do you see this? The actual return is 4 million, but what seemed to have been already included in the books was only 3.25 million, right? Although it was just implicit, we did not see it. But 6.25, if in case we differentiated between assets and liabilities, we would actually have seen the 3.25 figure. So you find out that, oh, so what I have really earned exceeds what has already been taken to profit or loss by 0.75. So we say, where should we take it? We say, no problem. If for the income statement, no issue. So this remaining balance should go somewhere else, right? That's why we say this 0.75 should go somewhere. I hope you got this, right? So find out that, oh, according to this computation, we got here 4, but we find out that, oh, so that remeasurement component actually has to be adjusted with this $4 million, right? Okay, so we are told here that contributions paid into the plan, this include increased assets and so reduce the net obligation. Benefits paid will reduce both assets and liabilities and so no impact on net obligation. And the statement of financial position figure should be that last amount of 55. So in case you find something accounting treatment, you have to be very, very careful and watchful about that, right? Yes, so I think this was something very important. I'll find just one question. There is another question which is also fine when dealing with such matters. So this was a very, very important question. As for this one, I have no worries. And so, or maybe let's do this. All right, let's just read this question faster, and then maybe I could ask you some questions, or maybe you could just get something. Okay. The question says that on 1st July 23, Nick However started a defined benefit pension scheme for its employees and immediately contributed 4 million. So this is a contributional issue. The actuary has stated that the net obligation was 0.4 as at 30 June 20 x4. This is the end of the year, 1 year later, right? And the interest rate for good quality corporate bonds was 10% at 1st July 23, the beginning of the year, but 12% at 30 June 2024. We usually based on that at the beginning. The actual return of the planned assets was 11%. This was the actual return. The increased cost from the employees' service in the year was 4.2. Do you see this? Which can be assumed to accrue at the year end. Do you see this now? This is the current service cost, but they did not specify it obviously, right? The increased cost for service in the year. That means this is the cost of service relating to this particular year. So it's the current service cost. Again, on 30 June 2024, the end of the year, Makeover paid 0.3 million in settlement of the defined benefit obligation with the present value of 0.2. Now, do you see? We settled something. So you have to determine whether there is a gain or loss, right? So you settled, you paid 0.3 million to settle something costing or with an obligation of 0.2. So it means you paid more. You paid more than what we are owing, right? And so we said that there should be again a loss in settlement, right? 0.3 minus 0.2 would have the loss in settlement. Again, you're told that this related to staff that were to be made redundant, although as at 30 June 2024, they still had an average remaining employment term of 1 month. Oh, so they still had a 1 month. The redundancies were not foreseen at the start of the year. So at the beginning of the year, we had not seen that redundancy. So in usual circumstances, we would have determined the gain or loss on settlement. Now let's go and see how you should have proceeded, right? Require discuss the correct accounting treatment as usual, just the accounting treatment for the year ending that is June 20 x4. These questions are usually direct. We just need to be conversant with how they are brought in an exam. Okay, I think let's just try to go to, didn't they show any computation? Yes, I wanted this one. This is the most important point. So the computations usually start here, right? So we have a net obligation brought forward, which was not given, so it just we put it as 0. We are given the contributions. The contributions increase assets, and so we said that for assets with a negative sign. Net interest component, as usual, as for net interest components, is you just take that discount rate at the beginning times this net obligation, right? Now you have to be very careful about this, right? Take a look. Usually we take the net interest component and multiply by the net obligation, but right here we determine the contribution first. You have to read the question and understand. Maybe the contribution could have been made immediately. If the contributions are made immediately, it means that that opening interest accrues. The interest accruing in the year would also be inclusive of that contribution made, right? That's why if you read here, you find out that it immediately contributed 4 million. So this contribution, if not specified, you just say, oh, contribution was at the end of the year. But if specified at the beginning of the year, you also have to adjust that opening balance first before determining your interest, right? Yeah, so that's what should have been the case. That's why net interest component was computed after including contribution. So be very watchful about this. All right, service cost component, we have current service cost, service in the particular year, it was given as 4.2. And as for past service cost, we said when there is a curtailment or amendment, this is part of a past service cost. And we have the loss on curtailment because we said that we paid $0.3 million to settle a liability of $0.2 million. And so there was a loss on curtailment, and the loss would actually increase the expense. And so the total service cost to be presented to profit or loss should be 4.3, right? Just like that. All right, and after having done that, we have the benefits paid, which we said have no impact here. And so you'd have your carrying amount. So you just compare to the net obligation at the end, which was the figure that was given, and then you do comparisons. Comparing this figure here and this figure here, you would have to obtain something, because this is 0, 4.4 minus 4.3, it's negative 0.1. So negative 0.1 to 0.4, it actually shows that the liability has increased by from 0.1 negative to 0.4 positive. That means something has increased from net assets to liabilities, right, by 0.5. And this should be the actually the loss, remeasurement loss or actuarial loss, right? So that is the case, and maybe you have to join